Hey everyone, welcome back to Janice Talks. Today we're tackling a giant, Google, or more accurately, its parent company, Alphabet. We just got their latest report card, their Q1 2025 earnings. So the big question is, did Alphabet just smash it out of the park this quarter, or is there more to the story?
Hey, I do have the Alphabet numbers, and stock is surging after hours, up nearly 6.5%. It is a beat on both the top and bottom lines. EPS coming in at $2.81. That is well above the $2.01 that was expected. Revenue also a slight beat here, $90.23 billion, $89.1 was expected. I also just want to separate out Google search and other revenue. This is important because it's been exposed to Chinese e-commerce and the tariffs, as well as the switch to generative AI chatbots. That is coming in essentially in line at $50.7 billion. $50.5 was expected. So perhaps a relief from some investors who were worried that its market share, its ad revenue was going to be eaten away by this move to generative AI. Last one I want to give you.
Their stock price definitely reacted positively after the news broke. But does the full report actually justify the hype? Especially with all the buzz around artificial intelligence. We're going deep today, breaking down exactly what Alphabet reported for the first 3 months of 2025. Why is this report so significant? Well, Alphabet is at the heart of the AI revolution, investing billions. Investors, analysts, and frankly anyone using the internet wants to know, are those massive bets starting to pay off? Plus, how are they navigating things like economic uncertainty and increasing regulatory pressure? Stick around because we're unpacking it all in plain English. All right, let's quickly set the scene. We all know Google. It's how most of us search the web, watch videos on YouTube, navigate with maps, check our Gmail. But Google is actually part of a larger company called Alphabet Incorporation. Think of Alphabet as a parent, and Google is its biggest, most important child. Alphabet also owns other companies exploring future tech, like Waymo, which develops self-driving cars. They call these other bets. But the vast majority of Alphabet's money comes from Google's operations: search ads, YouTube ads, Google Cloud Services, Android, Pixel phones, and various subscription services like YouTube Premium. They are a dominant force in digital advertising and a major player in the booming cloud computing market. Now, context for this earnings report. Going into Q1 2025, expectations were high, but there were also questions. The tech world has been pouring money into AI. Would we see concrete results in Google's numbers? How would their core advertising business hold up? And could Google Cloud continue its impressive growth and crucially improve its profitability against tough competitors like Amazon's AWS and Microsoft's Azure? Remember, last year saw strong growth, particularly in certain advertising sectors like finance. Could they keep up that pace? That's the backdrop for the numbers we're about to dive into. Okay, let's hit the big numbers everyone looks for first. For Q1 2025, Alphabet reported total revenue, a massive $90.2 billion. That's up 12% compared to the same time last year. Revenue is simply the total amount of money the company brought in from selling its services, ads, cloud, subscriptions, etc., before expenses. A 12% jump means they brought in significantly more money than Q1 of 2024. Operating income, $30.6 billion. This was up an even stronger 20% year over year. Operating income is what's left from the revenue after paying the day-to-day costs of running the business. Things like salaries, marketing, maintaining data centers, but before taxes and interest. A 20% increase here is great news. It means their core operations became significantly more profitable. Net income, $34.5 billion. That's a huge 46% surge compared to last year. Net income is the bottom line, the profit left after all expenses, including taxes, interest, and other income or losses are accounted for. A 46% jump looks incredible on the surface. Earnings per share, or EPS, was $2.81. This was up 49% year over year. EPS takes the total net income and divides it by the number of company shares out there. It tells investors how much profit is attributed to each share of stock. A 49% increase is a big deal for shareholders. Now, how did this stack up against what Wall Street analysts expected? Alphabet beat expectations pretty much across the board. Revenue was slightly higher than the forecast of around $89.1 to $89.2 billion. Operating income also beat estimates. And that EPS number, $2.81, absolutely crushed the average analyst estimate of around $2.01 to $2.02. But there's a very important asterisk next to that huge net income and EPS jump. It wasn't all from selling more ads or cloud services. A big chunk of that profit came from something called other income. Specifically, Alphabet recorded an $8 billion unrealized gain on an investment they hold in a private company. News reports suggest this company is SpaceX. An unrealized gain means the value of their investment went up significantly on paper, but they haven't actually sold it and pocketed the cash. It's like if your house value doubles, you're richer on paper, but you don't have the extra money in your bank account unless you sell. If we adjust for that $8 billion paper gain, the EPS is closer to $2.27. Still a solid beat over expectations, but it gives us a clearer picture of how the actual business operations performed. And the good news is, even without that gain, the operational performance was strong, shown by that 20% jump in operating income we talked about. Another key metric, operating margin. This tells us how much profit Alphabet makes for every dollar of revenue from its core operations. It improved to 33.9%, up from 31.6% last year. That's a solid improvement, showing better efficiency despite rising costs in some areas. Okay, headline numbers are one thing, but why do they look like that? Let's break down the different parts of Alphabet's business. First, Google services. This is the engine room: Search, YouTube, Android, Pixel, etc. Overall services revenue, $77.3 billion, up 10% year over year. Services operating income, $32.7 billion, up a strong 17%. The profit margin here expanded nicely to 42.3%. Let's look inside services. Google Search and other. Still the king, revenue hit $50.7 billion, up 10%. Alphabet said growth here was strong, boosted by AI features. They specifically mentioned AI overviews. Those AI-powered summaries you might see at the top of search results are now used by 1.5 billion people monthly and are increasing engagement. They also highlighted growth from financial services and retail advertisers. YouTube ads brought in $8.9 billion, also up 10%. This was driven mainly by direct response ads, the ones urging you to click or buy now. and also solid growth in brand advertising, helped by events like Coachella. Watch time is growing, especially on living room TVs and YouTube Shorts. Google Network. This is revenue from ads shown on partner websites and apps. It actually declined 2% to $7.3 billion. This has been a weaker spot for a while. Subscriptions, platforms, and devices. This was a star performer. Revenue jumped 19% to $10.4 billion. This includes things like YouTube Premium and music subscriptions, now over 125 million subscribers globally, including trials. Google One cloud storage subscriptions, Play Store revenue, and hardware like Pixel phones. Alphabet now has over 270 million paid subscriptions across all its services. Next up, Google Cloud. This is Alphabet's challenger in the massive cloud computing market, competing with Amazon AWS and Microsoft Azure. And the story here is really interesting. Cloud revenue, $12.3 billion, soaring 28% year over year. This growth was led by demand for their core cloud platform, especially driven by companies needing infrastructure for AI. Google Workspace, their business suite like Docs, Sheets, also contributed. While this strong growth was slightly below some very high analyst expectations, it still represents huge momentum. Cloud profitability. This is the headline grabber within cloud. Operating income reached $2.2 billion. That might sound small compared to the billions in services, but it's up 142% from just $900 million last year. Cloud operating margin jumped dramatically to 17.8%, almost double the 9.4% margin from Q1 2024. This margin improvement is huge. It shows Google Cloud isn't just growing fast, it's becoming much more efficient and profitable as it scales. This could be due to getting bigger, managing costs better, or perhaps selling more high-margin AI services. This is critical for Alphabet as it proves cloud can be a major profit contributor, not just a revenue grower chasing market share. They also made a huge move to bolster cloud by announcing plans to buy cybersecurity firm Wiz for $32 billion, their biggest acquisition ever. We'll touch on that again later. Finally, the other bets segment. These are the long-term, more experimental projects. Revenue, $450 million, actually down 9% year over year. Operating loss, $1.2 billion loss, wider than the $1 billion loss last year. Alphabet noted last year's number was helped by a one-off payment, making the comparison tricky. The main story in other bets is Waymo, the self-driving car company. Despite the segment's loss, Waymo hit some operational milestones. They're now doing over 250,000 paid passenger trips per week, a five-fold increase from the previous year. They launched paid services in Silicon Valley and expanded in Austin via a partnership with Uber. They're prepping launches in Atlanta, DC, and Miami too. This focus seems to be on partnerships to help them scale, which might be a smarter, less cash-intensive way to grow. So, what did Alphabet's leadership, like CEO Sundar Pichai, have to say about all this? Artificial intelligence was front and center. Pichai emphasized their full-stack approach, meaning they work on everything from the underlying computer chips, like their new, more powerful TPUs called Ironwood, and infrastructure, to developing the AI models themselves, like the new Gemini 2.5, and integrating AI deeply into products like search, cloud, Android, and workspace. They noted all 15 of their products with over 1 billion users now use Gemini models. Regarding the future outlook, capital expenditures, or CapEx, they reaffirmed plans to invest around $75 billion in CapEx for the full year 2025. CapEx is money spent on long-term assets like buildings, data centers, and powerful servers. This huge $75 billion number shows they are investing massively in the physical infrastructure needed for AI and cloud growth. Growth moderation. They gave a slightly cautious tone on near-term growth. Growth moderation. They gave a slightly cautious tone on near-term growth. They expect growth in Google services, advertising to moderate a bit as the year progresses, partly because they're comparing against very strong results from last year. For Google Cloud, they said growth might vary quarter to quarter depending on when large capacity deployments happen. Strategic moves. $32 billion planned acquisition of cybersecurity firm Wiz is a massive strategic bet to significantly boost Google Cloud security offerings, making it more attractive to big enterprise customers, especially in a multi-cloud world. This deal still needs regulatory approval. However, management also highlighted some headwinds challengers are facing. Accelerating depreciation. This is a direct consequence of that huge CapEx spending. As they buy more servers and build more data centers, the accounting cost of those assets spreading out over time, depreciation, goes up. The CFO explicitly warned that depreciation expense grew 31% in Q1 and will accelerate through 2025, putting pressure on profit margins. They are focusing on efficiency internally, even using AI to help write code or prepare for earnings calls to try and offset this. Regulatory scrutiny. This is a persistent cloud hanging over Alphabet. They face major antitrust challenges. In the US, an ongoing DOJ lawsuit challenging their search dominance and a separate court ruling that their ad tech practices are an illegal monopoly, potentially leading to forced challenges. The Wiz acquisition will also get a close look from regulators. In the EU, the Digital Markets Act, DMA, is creating headaches. The EU Commission has preliminary findings that Google might be unfairly favoring its own services in search results and restricting app developers in the Play Store. Fines could be enormous if they're found non-compliant. Competition. It remains fierce everywhere. Search, cloud, ads, AI models. Macroeconomics. Broader economic slowdowns could impact advertiser spending. Okay, lots of numbers and details. But what does it all mean for the stock and for investors like us? As we saw, the stock reacted positively. Google shares jumped around 4 to 5% in after hours and pre-market trading immediately following the report. Why? Investors clearly liked the strong revenue and especially the big EPS beat, even considering the SpaceX gain. The impressive cloud profitability jump was likely a major factor, signaling that this key growth engine is becoming financially stronger. The increased dividend, up 5% to 21 cents per share quarterly, and the massive new $70 billion share buyback authorization also signaled confidence and a commitment to returning cash to shareholders. Dividends, a direct cash payment paid to shareholders, usually quarterly. An increase signals confidence in future profits. Share buybacks, when a company uses its cash to buy its own stock from the market. This reduces the number of shares outstanding, which can boost the EPS for the remaining shares and often supports the stock price. A $70 billion authorization is huge. So what are the key takeaways for someone following Alphabet stock? Remember, this is not financial advice, just discussing implications. AI is real and expensive. The results show AI isn't just hype. It's driving engagement in search and demand in cloud. But it requires massive ongoing investment, $75 billion CapEx, which will drag on margins via depreciation. Investors need to weigh the growth potential against the cost. Cloud is maturing profitably. The jump in cloud margins is a significant positive inflection point. It suggests Google Cloud is gaining efficiency and scale, potentially becoming a much bigger profit driver sooner than expected. Core business still strong. Despite concerns about competition and the economy, the core search and YouTube advertising businesses delivered solid growth. Subscriptions are also becoming a meaningful contributor. Regulatory risk is high. The antitrust cases and DMA compliance are serious threats that could potentially force changes to Alphabet's business model or result in large fines. This remains a major uncertainty. Shareholder friendly. The dividend increase and huge buyback show Alphabet is focused on returning value to shareholders, supported by strong cash flow generation. $19 billion in free cash flow this quarter alone, even after heavy investment. Does this report fundamentally change the investment thesis? For many, it likely reinforces the view of Alphabet as a resilient tech giant, successfully navigating the AI transition, albeit with significant costs and risks. The cloud profitability story is a definite plus. The regulatory overhang remains the biggest question mark. How does Alphabet's performance fit into the wider tech landscape? Google Cloud's 28% growth is strong, but we need to compare it to rivals. Microsoft reported its Q1 results for their fiscal year ending September 2024, showing very strong cloud growth too, with their overall cloud revenue up 22% and Azure specifically up 33%, also heavily fueled by AI demand. They are also investing heavily, spending $20 billion on CapEx in their quarter. Amazon and Meta were expected to report their Q1 results shortly after Alphabet, around the end of April 2025. Preview suggested Amazon's AWS growth might be in the teens, though some expected higher, while Meta was facing potential ad slowdowns, but also investing massively in AI infrastructure, $60 to $65 billion planned for 2025. The takeaway? The cloud and AI infrastructure race is incredibly intense and expensive for all players. Google's accelerating profitability in cloud is a key differentiator this quarter. Digital advertising. Alphabet's 8.5% overall ad growth, driven by 10% in search and YouTube, is solid. Pre-earnings reports suggested Meta might see slower ad growth, about 13%, due to factors like nervous spending from Chinese e-commerce giants amid trade tensions. It highlights that while digital advertising is still growing, the environment might be getting tougher and platform performance can vary. AI investment arms race. Alphabet's $75 billion annual CapEx plan is staggering, but Microsoft's $20 billion quarterly spend and Meta's $60 to $65 billion annual plan show this is an industry-wide phenomenon. Building leading AI requires unprecedented investment in computing power. It's easy to get lost in billions of dollars and percentages, but let's bring it back to us. That 1.5 billion people using AI overviews in search, that's potentially you, me, our neighbors, getting quicker answers or summaries when we Google something. It shows how AI is subtly changing our daily internet habits. The 125 million YouTube Premium and Music subscribers, that reflects more people deciding ads are annoying enough to pay to avoid them or wanting features like background play on their phones. Google Cloud's growth, that's powered by businesses, big and small, moving their operations online, using Google's infrastructure to run their websites, analyze data, or build their own AI tools. It's the backbone of many apps and services we use daily. The Waymo trips, while still limited geographically, 250,000 paid trips a week means real people are trusting self-driving cars for their commutes or errands in cities like Phoenix and San Francisco. My initial reaction to these numbers? Wow, that cloud profitability jump really stood out. I was also struck by the sheer scale of the AI investment. $75 billion is hard to wrap your head around. What surprised you the most? Let me know in the comments. All right, that's our deep dive into Alphabet's Q1 2025 earnings. We saw strong growth fueled by AI and cloud. Impressive profitability gains in cloud, but also huge investments and significant regulatory challenges ahead. What was the most surprising number or takeaway for you in this report? Did anything change your view on Google? Drop your thoughts in the comments below. I love reading them and getting the discussion going. If you found this breakdown helpful and easy to understand, please give this video a thumbs up. It really helps the channel. And if you haven't already, hit that subscribe button and the notification bell so you don't miss future deep dives into the companies shaping our financial world. Thanks so much for watching Janice Talks. Keep learning, stay curious, and I'll see you next time.